Hey everyone, so today's indicator either helps you make profits or drains your deposit. It all depends on how you use it. I'll show the correct way to implement it. My name is Evan Trader and I've been in the market for a very long time and trade systematically without guessing or magic buttons. So in today's video, I will explain how to use the stochastic oscillator together with tech analysis, where this strategy truly works and where it breaks down. I will also demonstrate real trades in practice. I remind you that I have my own Telegram channel. The link is in the description and pinned comment. Join it. There are many interesting strategies and tricks I use and show you guys. There's a lot of information about trading and I'm always open to questions. I will help and explain everything in detail, so don't forget to subscribe. Let's go. What is the stochastic oscillator, simply put? So first, I'll explain it as simply as possible. It's an indicator that shows where the price is relative to its range over a certain period. So in other words, it doesn't just show up or down movement. It answers the question, is the price closer to the upper boundary of the range or the lower one, and how quickly did it get there? Essentially, it's an indicator of the speed and heating of the movement. Here I have it set up. It consists of two lines, a fast line which moves more sharply and a slow, smooth line that confirms the movement. So when these lines cross, it signals a potential change, but here's an important moment. A crossover itself is not a strategy, it's just an indication that something is changing. The levels of 20 and 80 are typically used in the stochastic analysis. Usually the stochastic oscillator is drawn from 0 to 100 with key zones below 20 and above 80. The biggest mistake beginners make is to buy only because the indicator is below 20 and sell only because it's above 80. The market can stay in the overbought or oversold zones for a long time and continue trending. So that's why we use the stochastic only with tech analysis to see the overall picture. So remember, overbought doesn't necessarily signal a reversal, and oversold doesn't mean it will immediately bounce back. So these signals only suggest that the price has reached an edge of its range and might be overheated. But a reversal must be confirmed by the overall context. So what we observe through, of course, tech analysis. Which stochastic signals are truly important? So 4 signals are important. The first one, exit from the overbought or oversold zones, the most useful one. For example, the stochastic drops below 20, then moves upward and indicates a possible reversal upward. So on the other hand, if it rises above 80 and then exits downward, it signals a possible reversal downward. Second, crossovers, possible future trend direction. So secondary and often noisy signals, but so they shouldn't be relied on solely. Also, divergence is also key. Bullish divergence. The price makes a new low, but the stochastic doesn't. So that suggests a potential upward reversal. Bearish diversion. The price hits a new high, but the stochastic doesn't, and indicating a potential downward turning point. It's important to note that sometimes the price trend continues and the stochastic doesn't reach extreme zones, which can also be a sign of a strong trend. So therefore, it's often best to observe the price behavior first. Levels, candle structure, and then check what the indicator shows. So why can't you trade the stochastic blindly? This is the most crucial point. So relying solely on the stochastic without tech analysis will lead to many losses, especially in trending markets. This indicator is not a confirmation tool, not a trigger. It should support your trading idea, not be the sole basis for it. So where does this strategy work best? In sideways or range bound markets after a strong impulse, especially when the price pulls back to support or resistance levels. So places where the crowd makes decisions and the trend logic exists, not just random noise. step-by-step example. So let's work with a currency pair. Let's first mark our support and resistance levels on our 1 minute chart. Marking levels is actually like the foundation of trading, so always do this, okay? So observe how the price behaves at these levels. For example, the price reaches a level, shows a long candle or a series of candles signaling a slowdown, and begins to reverse. The stochastic may show an entry signal such as crossing above 20 near a support level, indicating a potential buy. You can wait for a small pullback or go along with the trend based on the indicator's hints. So let's open a buy here. Let's just wait and watch what is going to happen on the chart. Please remember, don't rely only on the indicator. Many beginners believe that the indicator is like a secret button for money. But that's very false. They neglect levels, tech analysis, and different time frames, or pair selection as well, thinking that the indicator will do everything. The indicator is just an auxiliary tool. You have to remember that. So, moving on. What are the main mistakes when trading with this indicator? Mistakes that cause people, roughly speaking, to blow their money. It's trading on every signal, ignoring the trend and context. Context is given by tech analysis. So I repeat, don't wait for confirmation. Enter directly into the zone. And we close in profit. Congratulations. Leveraging risks because the signal is strong and opening trades based on emotions. I won't get tired of repeating in every video that I have. Emotions in trading are not an assistant. They're our enemy. So that's why emotions need to be dulled and approach the analysis with a cool head. Let's switch to another second currency pair and open another order. Let's look here. So I don't like the volatility here. I don't like this pair at all. In situations like this, when small candles form and then suddenly big candles in the opposite direction, it's a sign of a potential reversal anywhere. A very unreliable market situation. So we don't even look at the indicator. Just based on the chart, we see that this pair is not suitable for trading right now. So let's choose another one. For example, okay, so here I'm looking at the 1 minute history of this chart. So with the 1 minute chart, I already understand a lot. But here there's a clear level, almost reached it, or rather didn't quite reach it. Now there's a small pullback down. It might go to that level. I mean, we can play around for a bit, wait for the pullback. So just as it reached 80, let's wait for it to rise a little and then go for a sale. Let it grow, no need to rush. I'll wait a little bit more for the pulsation, but I'll open a position now because it sharply went down. It might bounce back, nothing scary. Remember, trades can be negative. We're not robots, we're humans, we make mistakes. The market is also alive, so losses can happen. It's not scary, let's just observe the situation. Of course, using the martingale system, we can carefully recover those losses. Okay, so we hit the level, it even slightly overshot it. Yeah, so it crossed it and we entered. But now a candle is forming downward, and I think based on the remaining time, a downward pullback will happen. And this is also confirmed by the indicators above 80. No crossings yet, but everything points to it. So already a small breakout downward. You can see, I think it'll go well now, and we'll close in profit. I don't think it will go much lower, but in our favor. No, it's returning back. Nothing scary. Negative trade is also part of the experience. Now I'm going to increase using martingale to 300 and wait. Already there's a crossing of the lines, but two candles formed quite large, so I just wait for a slight pulsation down and open a sell. I'm already starting to go down, but I think from here we can start and we'll see how it progresses. So I'm more than sure then that a reversal will happen just now. This candle is very long and leaves a tail, but it's kind of behaving unstable, and a third candle is forming, and everything now points to a reversal. At least the indicator suggests it with the crossing and overall market like cyclability. So this is a similar story. The market moved up, then fell. It moved again, then fell. The market is a cycle. It shows us a lot, and just as the chart as well. The indicator is just an additional tool. I repeat that. It's essential to use it together with tech analysis. This indicator is often used with RSI, moving averages, and other indicators. So I will talk more about this multiple times in our upcoming videos. Now a very confident candle is downwards. It just started just as we discussed, and we close in profit. Once again, congratulations on that. Great. It's working perfectly. So I will also slightly increase the position size on this currency pair. Okay, so now it already broke below 80. I'm not going to place a sell order right now. I'll just wait for the candle to grow more. Then put it in a buy, because I don't think it will go down significantly lower. So a strong drop is not expected at the moment. I think it will pulse around. A candle is forming now that might even reach the size of the previous rising candle. This actually could be a good opportunity for a buy to play on the rebound, but we're not in a rush. We just wait. And we don't rely solely on the indicator. See how the level below 80 is coming into play? The gap between the lines is forming, and let's open a buy. I'll wait for the second candle to grow a bit more. It's uncertain, it's moving back and forth, so I think a reversal might happen just now. Here, it's fighting back, like pulsating back and forth. You can see it forming. Bam, right there, then back again. So many get confused here and start opening short orders. I don't recommend beginners to do this at all. Stick to a 1 minute order for now. That's a very solid working model. Or just go for a slightly longer time frame. I typically show the 1 minute chart as my standard in my videos. So understand correctly, even the best strategy won't save you from risk. One trade shouldn't break your balance. If you risk too much, your balance will go negative, even with a good strategy. So as you see, we are in profit today. 3 successful trades, 1 losing trade, but I think we still made good money. $628. That's good. That's good for today, for just 3 trades. So what I want to tell you, and the main takeaways. So stochastic is not magic. It's an indicator that shows where the price is within a range and how overbought or oversold the market and the movement is. So it only works well if you use it correctly. The idea is to combine tech analysis with confirmation from the stochastic. And of course, trade at your own risk. If you want strategies and real chart breakdowns like today, write stochastic in the comments and I will make a follow-up video with examples paired with other indicators as well, giving this indicator more attention. So we will be returning to this indicator multiple times, but if you're truly interested in how to work with it, just let me know. And I will record a specific video about this indicator. Okay, so now I'll be withdrawing my profit. So to do so, I enter my wallet details, and the $622 we earned today will be flying to my account. By clicking continue, all the funds will be sent and they will arrive within 20-30 minutes. I remind you that my Telegram channel offers many strategies. You can copy my signals there. I share various tips, discuss different trading theories, and talk a lot about practical aspects. All of this is available on my Telegram channel. The link is pinned. Join me there. There is a lot of useful information, and I'm very glad to see you in each of my videos. Remember, we are learning so we can earn steadily in the long run. So good trading to everyone, and goodbye for now.